Welcome and thank you for joining us today for our webinar on the One Big Beautiful Bill and charitable giving impact. My name is Dan Steinfield. I'm head of school here at Delaware County Christian School, and I'm joined today by two individuals, two experts in this area, Robyn Jameson, a wealth manager, and John Wichard, a CPA. But more importantly, these are DC parents. They're members of our development committee, and we're very grateful, Robyn and John, for your willingness to share some time with us today and walk us through some of the impact that our families can take advantage of as we come to year-end giving here in December.
Yeah, happy to be here, Dan, and thanks for the introduction. So I have three daughters. One graduated from DC 2.5 years ago. I guess 3.5 years ago. She's going to yell at me for getting that wrong. We have a senior and a freshman right now. All of them grew up in Christian schools. And, what I've come to find out, Dan, is, when we enrolled our children in these schools, we were drinking from wells we didn't dig. Mm-hmm. And we were enjoying the fruit of vineyards we didn't plant, and right. What does the Lord say? He says, remember me. Mm-hmm. When you're eating, you're fed. And, and another revelation that kind of came to me along the way was tuition alone doesn't get it done. And after 75 years, this school's been through many seasons, many plantings and many well diggings, and we're in one of those seasons right now. That's right. So, and who are those who are going to dig this well? I'm looking around the table, right? And I'm looking into this camera and those who have logged into this webinar. There's another thing about this season that's really important, and that is that we have some tax law changes on the horizon. And so given Robyn's background, my background, even though these are our personal views and not the views of the firms that we work for, nor the views of the school, we thought it would be helpful just to share those with people who are in the fellowship right now. Should I just kind of get started with it?
Let's go right into it.
All right. So we have a slide here that it's labeled quick hits on the OBBA, or the One Big Beautiful Bill. So these tax brackets won't sunset. What does that mean? Well, that just basically means that the tax brackets are the same. They didn't expire under this bill. So from 25 to 26, they're roughly the same, plus or minus some inflationary changes applied to the income within those brackets. However, 529 plans, there's an additional $10,000 deductibility or contribution limit provided in the bill. And state and local SALT, we call it, tax deductibility, has increased substantially. You might remember several years ago under the prior act, it was limited to $10,000, which was a big deal, especially for folks in places like New Jersey, New York, California, and even us here in Pennsylvania. And therefore, that pushed some people into the standard deduction, which we'll talk about in a little bit. Now that's grown to $40,000 for most people, as long as your income is below $500,000, and I think it completely phases out at $600,000 of household income for most, and we'll have a slide on that as well. Charitable deductions has changed a little bit. It kind of frustrated me. I always felt like charitable contributions were kind of like the sacred cow and should not be touched by the U.S. government to incentivize those to give to places like, of course, our church first, and then free will offerings to the school. And what essentially the bill does, and Robyn will cover some examples, is put bookends on it. So like the first 0.5% of your AGI will not be deductible. And for the high income earners, they kind of took off 2% of the highest tax bracket of 37%. The deductibility of charitable contributions is only now 35%, which is unfortunate in my view, but it is what it is. But what does that mean for us here? Just a few weeks left in calendar 25. Well, you get to enjoy the benefit of the increased standard deduction if you're in that bucket, while also not having to be bookended by these new restrictions on charitable giving. And that's basically the quick hit overview I thought I would give. The next slide shows the actual standard deductions for ordinary individuals who would not otherwise itemize, most of us. Unless you're 65 and older, there is a little bit of a kicker bonus, assuming your income doesn't exceed certain limits. And of course, you should consult with your tax advisor to know kind of where you fall in all these buckets. The next slide shows a chart of the new state and local tax deductibility over the horizon of whatever your income might be. So if you're single, head of household, married, filing jointly, it's the same. If you're filing separately but married, the income limits are roughly half that, as you might imagine. So with that, I don't know, Robyn, did you want to pick it up from here?
Yeah, of course. I think because of these SALT caps kind of increasing so significantly, one of the things that we believe we will see as a result of that is a lot more taxpayers itemizing, where maybe we've taken the standard deduction because it's just been hard to fill that gap between $10,000 and $30,000, right, of a standard deduction, and you pretty much only have mortgage interest and charitable contributions to get you there between the two. Now, with that SALT going all the way up to $40,000, there will be a much higher propensity for tax filers to itemize. So what does this mean for charitable changes? As John mentioned, there's a couple of interesting provisions that are in this bill. One is that beginning in 2026, there will now be an above-the-line charitable deduction that will be available. So for individuals, that will be $1,000 per year, and for married couples, that is $2,000 per year. However, it is important to note that contributions to a charitable fund or donor-advised fund are not allowed for these above-the-line deductions. They must be given directly to a 501c3 charity like DC. So for those that are taking the standard deduction, you can get your full standard deduction and now be able to achieve additional deductions through these above-the-line features that the bill has put in place. The next is this charitable floor that John mentioned. So there's a 0.5% floor if you are itemizing your charitable deductions. As a quick example, you make $100,000, your first $500 of giving to charity is not deductible now. So you give away $10,000, you can only itemize $9,500, right, of those dollars. If you are also in the highest tax bracket at 37%, you can only deduct at 35%. So essentially you have a 2.5% haircut in the highest tax bracket. And one of the other things that it's important to note from a charitable perspective is that appreciated asset giving and QCDs, we call them, that's our geeky acronym in our world for qualified charitable distributions. That's when you can give directly out of an IRA. Once you hit a certain age, we'll talk about that a little bit later as well. These rules remain unchanged, which is great to know, and strategies to be thinking through and to take advantage of. So a couple of things that we are actively talking to our clients about in terms of what is the strategy then from a charitable perspective around these changes. One of those strategies is to accelerate giving into 2025, right? Because we right now have no haircut. We have no 0.5% before we can itemize. And if you're in the highest tax bracket, you don't have that 2% as well. So consider accelerating giving into this year. One of the ways that you could do that is through the use of a donor advised fund where you can put contributions in today, get that tax deduction in 2025, and then even take a standard deduction for the next couple of years. Wanted to also just mention that if there's any large liquidity events, selling a business, a large bonus, an inheritance, highly appreciated investments, right? I mean, look at your investment portfolio. The market is up significantly, yeah. And are there certain positions that you can give to a donor advised fund, or even DC can receive those mutual funds, stock positions in kind, and you get to wipe out all the embedded gain within those holdings as they're given away. So you get a double tax benefit on giving appreciated securities. And then stacking deductions. I mentioned this just a second ago. So that's pulling forward a couple of years of charitable deductions in 2025 to get a full 100% itemized deduction here. Important to note, I don't know that we specifically said this, but that SALT increase to $40,000, that's effective now. That is a 2025 provision. These charitable impacts don't come into play until January, right? So we do have this little bit of a window at the end of the year to take advantage of some of these items. Dan,
Yeah.
we
Well,
would love to hear from you on this Next Gen campaign, which John and I behind the curtain have been able and privileged to be involved in. And for me, having 4 children that have been at this school, and just seeing the impact on each one of them, and having 2 now in the lower school, and knowing we were at the Christmas concert last night, and it was packed.
Yep.
I mean, there was standing room only.
with 700 seats, by the way, in that lower
Wow.
gym. Yeah. And standing room only. So,
Right. So I'm thinking, knowing what we're going to be talking about today, about imagining all of these children coming through middle school and upper school, and the vision of you and the leadership of this school to get out ahead of these improvements. We actually also are recording this in the podcast studio, which is kind of a closet. I actually didn't know where it was, but it's a closet in the basement in the mansion.
Yep.
And it will be not a closet when this is done, right?
That's
so
right.
Tell us about this.
Yeah, well, I'm excited to share a little bit about the future of Delaware County Christian School, but let me first say, Robyn, John, thank you so much for sharing your expertise, giving your time here to be able to bless our school families and those that are a part of the webinar here. We're really appreciative of it. And this is done, as you discussed, to support our Next Generation campaign, which we have publicly launched. It's a $30+ million campaign that we are doing for the future of Delaware County Christian School. And we see this as setting up DC for 2030 and beyond. We currently have 76 years that Delaware County Christian School has a beautiful history of Christian education in our community. Many of you that are on the webinar are, if not current families, you're alumni parents. We've seen thousands of families and students go through DC, and we're excited to position the school for the next 75 years, Lord willing. And these projects that you see on the slide here are just a glimpse into how we can prepare our facilities and prepare the school to be able to be ready for 2030 and beyond. And ready for 2030 and beyond speaks to volume, numbers. We're 950 students this year, pre-K 2 through 12, and we see the school rounding out around 1,000 students, and these facilities will help us be able to house those students, but it also prepares our school to have the facilities that we need to keep up with the programming that we're doing. Robyn mentioned the podcast room we're in. We have an innovation center led by Matthew DeFranza that is doing programming that's leading the country in Christian education, and that facility is under construction right now to give them the space that they have already grown into and are already doing in the programming that they're doing. I'll end by saying this. While this is a campaign, and campaigns are about brick and mortar, we're building facilities. At the heart of DC are our faculty and staff. At the heart of DC are our students, our parents. And so, yes, we're trying to build facilities, but we're doing that to give our faculty and staff, who are master teachers, disciplers of students, we want to give them the best spaces possible to do that great work. And we want to see students who have these opportunities to be in these spaces go out into every sphere of influence in the world and be able to be impact players for God's kingdom. So that's a glimpse into the Next Generation campaign.
Amen.
John, how are we going to pay for this?
Yeah.
While you're thinking of tax
Yes,
and year-end
let's talk
giving,
about strategy here for a second. We're numbers people, right?
Probably the most helpful thing we can do for everyone is to tell them how to give, right? And, probably everyone's familiar with QR codes and donation buttons, but in this case, we found it very important to demonstrate how much.
Yeah.
And this is the buildup. Okay, so just let me explain this chart. On the far left would be the gift amount at each level. And then the column just to the right of that are the number of gifts needed at each one of those levels. If you were to multiply that out and add it together for this kind of second to the right column called the road total, you get the $32 million. So Dan had mentioned over $30 million. That is the planned cost of this expansion. To date, the column in the middle, number of gifts obtained, is actually what's been committed by all of you watching, us here around this table, and our fellowship, and our alumni, which is, of course, in our fellowship, and that gets us to about $15.7 million, which is phenomenal, right? Mm-hmm. But here's the thing, if I was watching this right now, I would want to make sure I understood how much is needed for this campaign, because, I've been that guy who has clicked the button and gave 5,000, checked the box and thought, okay, I gave, right? But you can clearly see here that as God has provided to each of us, he really wants us to participate in this campaign at these levels. Let me add that we really are wanting those who are participating to do it over a 3-year period. Yeah. So these amounts are spread over 3 years. Now, Robyn highlighted how that might be advantageous and more efficient to do it all now, up front in 2025, depending upon what your tax advisor suggests to you. But if, in fact, cash flow works out better for you to do this over 3 years, by all means, do it over 3 years. You can see there are some very generous participants already at the top. We have one gift of $4 million, two at $2.5 million, right? And I'm sure you're thinking this. I'm thinking it. I can't make a big impact here. There's no chance. Someone gave $4 million. My 10 grand can't do much. Yes, it can. Yeah. There's going to be 40 of you do that, and that adds up. And that's why we have this chart. So hopefully that helps people understand kind of how all of us can participate to get to the 32 million.
Yeah, great.
So let's walk through a couple of case studies, right? We put together 4 examples, and I'm confident that you will relate to one or maybe 2 of these examples. So the first we'll call the standard deduction filer, right? So this is someone who will take that standard deduction. It doesn't make sense for you to itemize. And remember, one of the provisions in this bill beginning next year is an above-the-line charitable deduction in addition to being able to take your full standard deduction. This is new. If you are a married taxpayer, that's $2,000 that you can give above the line, right? So when we're thinking through a 3-year pledge, one of the things we're suggesting here is, okay, $2,000 a year times 3 years, that could be a $6,000 impact to this campaign as a married filer, $3,000 as a single filer. And then you can see in yellow on the slide the total tax savings. We're assuming a 24% tax bracket in this scenario, and you can see there's about $1,400 of married tax savings. So in this scenario, it's a little different. We're actually suggesting maybe shifting the actual gifts out of 2025 into 2026, and then giving that 3-year pledge in the beginning of the year of 26, 27, and 28. The next example we'll call a borderline standard deduction or itemizer, right? So you might one year take the standard deduction, you might another year because of your giving, itemize. This is where really this gift bunching, or we call it sometimes the lump and clump strategy, right, is where we're pulling charitable deductions forward into this tax year and plan to itemize then in 2025 and then take the standard deduction intentionally the next couple of years. In this tangible example, let's assume there's $175,000 of family income. That would put someone in a 24% tax bracket, and we'll assume a $10,000 annual gift. Over 3 years, that's a $30,000 potential pledge to this campaign. And the difference between doing that and pulling it forward into 2025 rather than giving it each year in 26, 27, 28 is essentially about over a $600 savings in taxes paid by just pulling that gift forward and taking that 0.5% floor, right, out of play here. The other thing just to mention is if you're doing a $10,000 annual gift beginning in 26, you probably want to consider splitting that to $8,000 that you're itemizing and $2,000 that you're putting in that above the line category, right? Third example we'll call the high earner. So this is someone that's in the highest tax bracket, 37% tax bracket. We'll assume $800,000 of family income, $100,000 annual giving, and at that rate, you traditionally right now have a 37% deduction. So you give $100,000, you get a $37,000 deduction or tax benefit of that gift. The higher income goes, the more there will be an impact of pulling these gifts forward. So in this example, doing this $300,000 pledge now, pulling that giving up front, will actually achieve about a $10,000 savings in taxes paid. That's actual dollars you pay in taxes to accelerate that gift into 2025 rather than pay it over the next 3 years. And so a really significant impact, right, for these higher wage earners from a tax perspective. And if you layer that with the use of a donor advised fund and the use of giving highly appreciated securities and wiping out embedded gains within those holdings, it's an even greater impact, right? And just to note that if you are giving appreciated securities, you are limited to 30% of your adjusted gross income. So you do want to just be paying attention to that, right, from a perspective of making sure that you're, within that threshold, because you won't lose the deduction. You can actually, if you go over that 30%, you can carry your charitable deductions forward for up to 5 years. So you won't lose it, but it is something, if we're trying to accelerate intentionally into 25, that you do want to be paying attention to that threshold. The last example we'll call our retirees, right? Retirees who are over age 70 and a half. That is the arbitrary age. I don't know why it's 70 and a half. Someone thought that was a good idea. For that to be the deemed age of now I can give qualified charitable distributions out of my IRA, right? And so, whereas when you turn a certain age, the IRS mandates you've never paid taxes on your IRA, right? We put money into a 401k or an IRA for all these years. We tax defer it, and the IRS says, excuse me, I'd like my tax money now, right? So they make us take these distributions out. And when that happens, a lot of times people don't necessarily need them. They have Social Security that's coming in. They might have a pension. They might have other assets that are paying dividends and interest income. And so they don't necessarily need to spend all of those required distributions that are coming out of the IRA. So there is a provision, and this is unchanged. So this is applicable right now and moving forward within this bill, with a little bit of inflation stacked on to, you could give up to $111,000 per person. So a married couple actually can double that if you'd like. Well, I'm sure you'll take the full amount if somebody wants to double.
That's right.
Right, Dan?
Yep, we can help them with
okay. The other advantage of giving out of your IRA is twofold. One, you can still take your full standard deduction. Now remember, one of the provisions in this bill is if you're 65 and older, you get an additional $6,000 onto your standard deduction. So for married filers, your standard deduction is close to $42,000. So it takes a lot of giving to kind of get above that and itemize. So you can take that full standard deduction plus giving then from your IRA, you basically get to itemize or deduct through that above the line deduction. The other thing that impacts in a really positive way is your IRMA or Medicare premium, right? Because now they means test Medicare in terms of the more money you make, the more you pay on the health insurance side of your Medicare premium. And this is a way that's all bracketed as well in different tax brackets. And this is a way you could actually get yourself into a lower tax bracket from a Medicare premium perspective, is by giving through your IRA, because it will reduce your adjusted gross income. So
yeah, great.
That was a lot. But
It's a lot of information, but John and Robyn, this has been really helpful. And I hope that you are thinking about year-end giving. I know you've got me rethinking a little bit of Kim and my year-end giving now that we have this information, but also understanding the changing landscape of charitable giving and where it's headed as we look into 2026. Most importantly, we hope you've gotten a glimpse of the Next Generation campaign here at Delaware County Christian School. You can go to our website, dccs.org, and find the Next Generation campaign tab. There's directions there on how you can give. But we're so thankful that you joined us, and I hope this has been helpful for you as you think through how you can contribute through your charitable giving to God's kingdom and a kingdom impact here at Delaware County Christian School. Thanks for joining us.
Amen.